Welcome back, folks, to Boss Economics World, the only place where we cut through the government's economic fairy tales and expose the dumpster fire of mismanagement they've created. Today, we're diving headfirst into the Federal Reserve's latest clown show, Jerome Powell's smug wait-and-see routine, and how it's setting the stage for an economic meltdown that'll make the Great Recession look like a picnic. Oh, and don't forget, your friendly neighborhood government. Yeah, they're the ones pouring gasoline on this fire. Buckle up, because we're about to tear this mess apart, from the bond market to your grocery bill. Let's go. Ladies and gentlemen, gather round, because the Federal Reserve is pulling out its favorite party trick, kicking the can down the road while pretending it's prudent policy. Last week, Jerome Powell, the maestro of monetary mayhem, doubled down on his "no rush to cut rates" sermon, leaving bond investors clutching their pearls and the rest of us wondering, how long can this circus go on? Spoiler alert, not long, folks. This isn't just a policy misstep, it's a flaming freight train of incompetence hurtling toward the economy, and guess who's driving? That's right, Uncle Sam and his merry band of bureaucrats. Let's break this down, shall we? Powell's latest excuse for keeping interest rates sky high is that the Fed needs more clarity on inflation and the fallout from Donald Trump's tariff tantrums. Translation: we have no idea what we're doing, so we're just gonna sit here and hope the economy doesn't implode. Meanwhile, traders are betting on less than a 3/4 point rate cut in 2025, with the first snip not happening until July 2025. July, folks. That's over a year of businesses suffocating under high borrowing costs, consumers drowning in debt, and the government pretending everything's hunky-dory. And let's not forget, options traders are so spooked, they're hedging against the Fed not cutting rates at all in 2025. Yeah, you heard that right. Zero cuts. Nada. Zilch. Now, let's zoom in on the first layer of this economic onion, inflation. According to the latest New York Fed survey, one-year inflation expectations just hit their highest level since 2023, while three-year expectations are at their peak since 2022. And guess what's fueling this fire? Our good old pal, Donald Trump, and his sweeping levies on Chinese goods. Powell himself admitted that these tariffs are jacking up inflation risks while simultaneously threatening unemployment. Gee, what a winning combo, higher prices and job losses. Who needs enemies when you've got a government like this? But wait, there's more. The Consumer Price Index, CPI, data for April 2025 is expected to show a 0.3% monthly rebound, according to Bloomberg estimates. That might sound small, but annualized, it's a 3.6% inflation rate, well above the Fed's sacred 2% target. And here's the kicker, this data doesn't even fully capture the tariff impact yet. As John Madziar from Vanguard pointed out, we won't see the real fallout until July 2025. So, buckle up, folks, your grocery bill, your gas tank, your rent. They're all about to get a whole lot uglier, courtesy of the government's brilliant trade war strategy. Now, let's peel back the next layer, the bond market, aka the canary in the coal mine of economic disasters. The two-year Treasury yield, which is hypersensitive to Fed policy expectations, just spiked by 33 basis points from its May 2025 low of 3.55%. Why? Because investors are waking up to the harsh reality that the Fed isn't riding to the rescue anytime soon. And hey, let's give a shout out to the U.K. trade deal and Trump's teasing of lower tariffs with China for throwing a little extra chaos into the mix. Risk appetite is up, yields are climbing, and the bond market is basically screaming, we're screwed. But here's where it gets juicy. Greg Peters, co-chief investment officer at PGM Fixed Income, dropped a bombshell. The bond market's accepting the fact that inflation is going to be higher than initially anticipated, and that is a complicating factor for investors' belief that the Fed will step in and cut rates. Translation: investors are losing faith in the Fed's ability to save the day, and why should they? The Fed's been wrong on inflation, wrong on growth, and wrong on just about everything else. Remember 2021, when Powell called inflation transitory? Yeah, how'd that work out? Spoiler, it didn't. Inflation hit 9.1% in June 2022, the highest in 4 decades, and the Fed had to jack up rates so fast it nearly broke the banking system, looking at you, Silicon Valley Bank. Now, let's dig into the next layer, the labor market. Powell and his cronies love to pat themselves on the back for resilient hiring, as the latest April 2025 jobs data showed. But let's not kid ourselves, this resilience is a mirage. David Rogel from BlackRock nailed it when he said, if you get a significant rise in unemployment and inflation is still running above target, the market view is that the Fed would prioritize stabilizing U.S. growth over inflation. In other words, the Fed's so obsessed with its 2% inflation fetish that it's willing to let the labor market implode. And guess what? Those tariff-induced price hikes we talked about. They're not just gonna hurt your wallet, they're gonna kill jobs, too. Here's a fun fact to chew on. According to a 2024 study by the Peterson Institute for International Economics, Trump's previous tariffs on China, 2018 to 2019, cost the U.S. economy 142,000 jobs. And that was before he decided to double down with even more levies in 2025. Now, with unemployment risks rising, the Fed's response is, wait for it, to do nothing. Brilliant. Why support the labor market when you can just sit back and watch businesses lay off workers to offset higher costs? I'm sure those unemployed folks will totally understand that the Fed needs more clarity before it lifts a finger. Now, let's zoom out to the big picture, the looming recession. Folks, the warning signs are everywhere. Inflation spiking, unemployment risks are rising, borrowing costs are crushing businesses and consumers, and the Fed's twiddling its thumbs. Meanwhile, the government's busy playing tariff roulette with the world's second-largest economy. What could possibly go wrong? Oh, I don't know, maybe a full-blown economic meltdown. Let's look at the data, shall we? The Conference Board's leading economic index, LEI, a key recession predictor, has been flashing red for months. As of April 2025, the LEI declined for the 24th consecutive month, signaling a high probability of a downturn within the next 12 months. And here's a fun historical tidbit, the LEI has accurately predicted every U.S. recession since 1960. But hey, I'm sure this time is different, right? Just like transitory inflation was different. And let's not forget the yield curve, the granddaddy of recession indicators. The spread between the 10-year and 2-year Treasury yields inverted in late 2024, and while it's since steepened slightly, the damage is done. Historically, an inverted yield curve has preceded every recession since 1955, with a lag of 6 to 24 months. Tick-tock, folks, the clock's running out, and the Fed's response is to wait for more data. Genius. Now, let's talk about the real villains here, the government. Jerome Powell might be the Fed's frontman, but the real chaos agents are in Washington, D.C. Trump's tariff obsession isn't just bad policy, it's economic sabotage. According to a 2025 report by the U.S. Chamber of Commerce, the latest round of tariffs could shave 0.5% off U.S. GDP annually, kill 500,000 jobs, and raise consumer prices by $1,200 per household per year. But hey, who needs economic growth when you've got political points to score, right? And let's not forget Congress, which has been on a spending spree that would make a Vegas high roller blush. The federal deficit hit $1.8 trillion in fiscal year 2024, according to the Congressional Budget Office, and it's on track to balloon even further in 2025. All this debt is crowding out private investment, juicing inflation, and putting even more pressure on the Fed to keep rates high. But sure, let's blame global supply chains or greedy corporations instead of the government's addiction to borrowing and spending. Folks, let's cut to the chase. This isn't just a policy misstep, it's a full-blown economic disaster in the making. The Fed's wait-and-see approach is a recipe for stagflation, high inflation, high unemployment, and zero growth. And the government? They're not just bystanders, they're the arsonists lighting the match with tariffs, deficits, and regulatory nonsense. So, what's the solution? First, the Fed needs to wake up and start cutting rates, yesterday. Second, the government needs to ditch the tariffs and get its fiscal house in order. But let's be real, folks, none of that's gonna happen. Powell's too busy chasing his inflation unicorn, Trump's too busy grandstanding, and Congress is too busy writing blank checks. Meanwhile, you and I are the ones who'll pay the price, higher bills, lost jobs, and a recession that could have been avoided if anyone in charge had a shred of competence. So, there you have it, folks, the Fed's a joke, the government's a disaster, and the economy's a ticking time bomb. But hey, at least you've got Boss Economics World to tell it like it is. Smash that like button, subscribe, and share this video with everyone you know, because the more people wake up to this mess, the better chance we have of holding these clowns accountable. Until next time, stay sharp, stay skeptical, and remember, the only thing the government's good at is screwing things up. See ya.